Welcome back to Smart Stock Sam, the channel where we cut through the chaos and decode the data. If you are new here, hit that subscribe button right now because today's breakdown is exactly why this channel exists. We are talking about Hims and Hers Health, ticker HIMS, a stock that just got absolutely punished last week, dragged through legal headlines, battered by a hostile macro environment, and dumped nearly 9% in a single session. But here is the thing, and this is what most retail investors are completely missing. The underlying fundamentals have not broken, not even close. Today we are going to walk you through what actually happened last week, why the original thesis still holds, whether this stock can realistically bounce back from Friday's gut punch sell-off and fresh legal scrutiny, and exactly what price levels you need to watch going into next week. This is the full tactical recovery blueprint, and we are starting right now. Before we dive in, you need to understand just how extreme last week's volatility was. In a single 24-hour window, the volatility stress on Hims stock peaked at a staggering 7.12%. Right now, we are seeing a 4.85% stabilization in volatility. And while most retail investors are still in full panic mode, the smart money is quietly building positions. Why? Because there is a massive difference between a stock that is structurally broken and a stock that has been temporarily knocked sideways by forces that have nothing to do with the company itself. Hims right now is the latter, and we are going to prove it number by number, level by level. To understand where this stock is going, we have to be completely honest about where it went wrong. On March 15th, the thesis was clean and compelling. The Novo Nordisk partnership represented a fundamental reset for the business, a catalyst powerful enough to drive a breakout week. And to be fair, the entry was validated. Monday opened at $24.22, right inside the optimal entry zone. Everything was aligned. But then the wheels came off in a way nobody predicted. We were targeting $26.50 to $30, yet the stock peaked at just $25.24 on Tuesday before the support floors at $23.85 and $23.53 were not just tapped, they were decisively broken. By Friday, the stock was sitting at $21.70. That is a textbook case of a genuinely great catalyst being completely swallowed by a hostile macro environment. The thesis was not wrong. The timing collided with a storm. Now let's zoom in on the final 2 trading days, because this is where the real story lives. Thursday gave us a glimmer of genuine hope. A 4.36% surge closed the day at $24.16. It looked like a resilient bounce that was tracking straight toward the 50-day moving average. Bulls were feeling it. The momentum felt real, and then Friday happened. An 8.86% decline, closing at $22.02. A gut punch, a complete reversal of everything Thursday had built. But here is the critical detail, that Friday collapse coincided with a broader 2% NASDAQ drop and a very specific legal headline that hit the wires at the absolute worst possible time. This was not Hims failing in isolation. This was a perfect storm. So what exactly created this perfect storm? When a stock deviates this violently from a bullish setup, it is almost never just one thing. It is always a convergence, multiple shocks hitting simultaneously from different directions. Inside the company, we saw high-volume insider selling alongside conservative forward guidance from leadership that crushed internal momentum. Outside the company, the broader market entered a full meltdown, and a fresh layer of legal scrutiny added fuel to the fear. 4 forces colliding at once: internal operational data and external macro market pressure hitting the stock from every angle at the same time. If you only look at the price chart, you are completely missing the mechanics of what actually drove that drop. Let's get specific about each of those shocks, because the details matter. On March 18th, an escalation in the geopolitical conflict across the Middle East wiped $800 billion from United States markets in a single session. Oil surged past $111 per barrel, and the VIX, Wall Street's fear gauge, spiked to 27. That is a get me out right now environment for any high-growth technology-adjacent stock, full stop. Then on March 17th, COO Michael Chi sold nearly $2,400,000 worth of shares. Yes, it was a pre-scheduled 10b5-1 sale, completely legal and pre-planned. But the optics were catastrophic for momentum traders. Add to that a Q1 revenue guidance figure that missed Wall Street consensus by approximately $30 million, and a new investigation launched by Kahn, Swick, and Foti regarding the company's compounded drug sales, and you now have 4 separate catalysts all pressing the sell button at the exact same moment. Here is where most retail investors make their biggest mistake. They see 4 negative headlines and they assume the entire story is over. It is not. In investing, the single most valuable skill you can develop is the ability to separate the noise from the actual signal. The noise here is the geopolitical war escalation, the temporary legal probe, and the short-term macro volatility. These are real, but they are transient. The signal, the thing that actually determines where this stock is in 12 to 18 months, is that HIM's structural narrative has not moved an inch. Massive institutional backing, aggressive global expansion into new markets, triple-digit earnings growth potential. The macro environment delayed the breakout. It did not destroy the thesis, and that delay is precisely what creates what we call a high-conviction mispricing. This is where fortunes get built, quietly, while everyone else is panicking. And if you want proof that the biggest players in the market agree, look no further than the ownership data. Smart money, institutional investors, now controls 63.52% of the entire float. We are talking about BlackRock. We are talking about Vanguard. But perhaps most telling of all, look at Steadview Capital. They increased their stake by 80% in just the last quarter alone. Think about that for a second. While retail traders were selling in a panic, one of the most sophisticated institutional players in the world was buying 80% more of this company. When institutions own nearly 2/3 of a business, they create a price floor. They are not day trading headlines. They are positioned for a multi-year cycle, and they are not moving because of a one-week sell-off. And what exactly are they buying into? They are buying a company that is aggressively transforming into a global healthcare titan. The $1.15 billion acquisition of Eucalyptus is a game changer that the market is currently sleeping on. This deal gives HIMS immediate, turnkey access to the United Kingdom, Germany, Canada, and Australia, 4 major international markets, scaled simultaneously, using infrastructure that is already built and operational. This is no longer a US-only telehealth story. This is a company laying the foundation for a global platform, and the market is too distracted by short-term oil prices to properly price it in. Does this expansion actually translate to the bottom line? The numbers say yes, loudly. We are looking at a projected 79% earnings growth rate. This is driven by what can only be described as sticky economics, a highly predictable, subscription-based recurring revenue model that generates cash flow quarter after quarter. And by pivoting aggressively toward higher-margin branded medications, including the Novo Nordisk GLP-1 weight loss drugs, HIMS is simultaneously expanding its margins while growing its revenue base. When you combine recurring revenue with expanding margins, the result is an exponential move in earnings power. That math is not going away because of one bad week. So if the financials are this strong, why is the stock trading at a discount? Because Wall Street, the professionals, are actually raising their price targets even as retail is selling. Needham sits at $30, Barclays at $29, Deutsche Bank at $28. The consensus price target among analysts covering this stock is $31.29. From Friday's close of $22.02, that represents approximately 42% implied upside. 42%. The gap between where this stock is trading and where professionals think it belongs is exactly where the opportunity lives. Now let's talk technicals, because the chart is sending an extremely clear message right now. The RSI, the Relative Strength Index, is sitting at 32.76. For context, anything below 30 is considered deeply oversold. We are right on the edge, and historically, when HIMS reaches these levels, the downward momentum is exhausted. Think of it like a rubber band that has been stretched to its absolute limit. The snapback is not just possible, it is technically probable. We are entering the optimal entry zone right now, and the clock is ticking. Here is your tactical blueprint for the week of March 23rd through the 27th. The single most important price level you need to monitor is $20.64, the Ichimoku Kijun dynamic support level. This is an algorithmic anchor that is critical to maintaining the macro bull trend. If HIMS holds above this level, the recovery will be sharp and potentially violent to the upside. This is the absolute line in the sand for the bulls. Below it, the narrative changes. Above it, the coiled spring analogy holds completely. On the support side, watch Friday's intraday low of $21.70 and the classic S3 pivot point at $21.11. On the resistance side, the 50-day simple moving average at $23.43 must be cleared for bullish confirmation, followed by the technical hurdle at $25.37. The conservative price target for next week is $24.50, reclaiming that psychologically significant round number. If we get any kind of macro tailwind, the aggressive target is $26 even, which would fill the gap created during Friday's sell-off. And now for the factor that could transform a simple technical recovery into something explosive. Short interest on HIMS currently stands at 40.84% of the float. That is 84.9 million shares held short with a 2.8-day cover ratio. That is an enormous short position. Now look at the March 27th options chain. There is a massive cluster of open interest sitting at the $24 and $26 call strikes. If price crosses that $24 strike wall decisively, market makers will be forced to hedge their exposure by buying the underlying stock. That buying pressure triggers a gamma squeeze, a mechanical, self-reinforcing buying cascade that could push this stock toward the $26 target in a matter of hours, not days. This is not speculation. This is options mechanics. It is how the market works when the conditions align. Before we wrap up, an important reminder, like always, nothing discussed in this video is financial advice. All price targets, analysis, and commentary are purely for educational and informational purposes only. Past performance does not guarantee future results. Always conduct your own due diligence and consult a licensed financial professional before making any investment decisions. Markets involve risk, including the potential loss of principal. So here is the final verdict. Monitor $20.64 like your portfolio depends on it, because for bulls, it genuinely does. The ignition point is a decisive break above $24, where the gamma squeeze mechanics take over and the move accelerates. The core thesis has not broken. Macro headwinds delayed the breakout, they did not destroy it. With 63% institutional ownership, a $1.15 billion global expansion underway, a 42% Wall Street consensus upside, and an RSI screaming oversold, HIMS is a coiled spring sitting in a high-conviction entry zone. The noise is temporary. The growth is structural. Stay disciplined, trust the levels, and do not let short-term fear make long-term decisions for you. Now here's the question I want you to answer in the comments below. If HIMS does trigger that gamma squeeze and rockets past $26 next week, do you think retail investors who panic sold on Friday will even have time to get back in before the move is over? Or will they be stuck watching from the sidelines again? Drop your honest answer below. If this breakdown gave you clarity, smash that like button. It genuinely helps this video reach more investors who need to see it. Subscribe to Smart Stock Sam if you are not already part of the community, and tap that notification bell so you never miss a breakdown when it matters most. I will see you in the next one.